Markets around the world are going absolutely ballistic, but what does it mean for us as traders and investors as positive gamma takes hold and some of the positions that we've been discussing start to hit their first targets? In today's video, we take a look at what's going on when it comes to the most important market sector in the world and what it means for us, along with what's happening in yields and whether Paul Tudor Jones could be correct about bad times still to come. Yes, join us today, guys, as we go through stocks, commodities, and cryptos to discuss one of the rarest and best breadth thrusts that we've just seen. A lot to go through. Let's do it right now together. Well, welcome back, everybody, to The Daily Show. My name's Tom, and in today's video, we have a lot to talk about. The latest macro, the big data, the key levels, and of course, what just happened in semiconductors as big announcements with chips being sold to overseas come through. Just before we get into some of the biggest information in today's video, I want to announce that we do have a free Sydney event coming up on the 4th of June, which is in the links in the description down below. If you live in Australia and you're able to make it there, we're sharing some information we've never done so on the channel, and I think you guys will enjoy it. Plus, we've got free drinks, so what have you got to miss out on? Meet some of the members of the community, and of course, it'd be great to see you there. So let's start off with the big story here, which is Paul Tudor Jones, and he says that the stock market will hit new lows even after the Trump reduction in tariffs. So of course, is he correct? Well, in today's video, we'll take a look at what this could mean if we're looking at a very similar period to some of the other US presidencies. But mostly we have to go with what we know right now, and that is that we are seeing breadth thrusts across the board. The De Graaf breadth thrust triggered over the last 24 hours, and this couples with the Zweig breadth thrust for some very nice stats indeed. According to Subu Trade, 3 months and 2 months later, we're 100% of the time up, and generally markets are up pretty decent percentages when this occurs. But is it everything smooth sailing? Is it all fantastic? Well, as you can see here, guys, we've got the latest data when we tend to see this particular read. And a lot of the time, the next 1 to 2 weeks, they can be a little bit more sketchy, but it's actually the next couple of days where you can sometimes see some sell-offs. Now, so far, the markets have not shown any signs of this. And even in the worst case scenarios after a De Graaf indicator had actually gone off with a Zweig one, we only usually have dropped at max 12%. You might say, well, only that's 12% happening in 2022. Yeah, but generally speaking, if you look at the next 252 days, up across the board. So what's the average here? Somewhere around 5. And that, of course, will just wipe us back to where we were at the start of the week. And the most important indicator, which is the 200 daily moving average. So let's have a look at the good signs. The first up one is the advanced decline line going to a new high. Obviously, this is really strong, and it tends to be symbolic of a market that's actually coming into a major recovery. And of course, when the Nasdaq 100 also closes above the 200 DMA after 7 weeks within that range, that is usually a good sign. Notice you get a lot of positive stats here for the next 2, 3, and maybe even 6 months in particular. And I think that's what we want to focus on here, because as we know, we still do have tariffs across the board. Now, you might see this blurry screen here and say, what am I looking at? Have I just gone blind? Well, no, you haven't, guys. But the big thing here is this is a share from Seth Golden. And I like it because what it shows us is that when the markets recover after a sell-off like we've just had, they tend not to be in a bear market just yet. In fact, even if we were going to the worst case scenario one, which was in 1957, after the market returned 16% and then sold off into a bear market, this is now the only one that's ever gone this far. So we've never seen a bear market turn off this particular sell-off. Now, that doesn't mean that we can't hit an all-time high in the future and then ultimately end up in a bear market, which is kind of the way I'm thinking about it. And obviously one of our base case scenarios at the start of the year, which was a 10 to 12% sell-off. Yes, we got more. Then a recovery, then lackluster results near the all-time highs, and of course, potentially some structural damage. But one thing is for sure is you usually do not see a market enter a recession when everybody thinks it is. And according to the latest polymarket data, we can see here that recession is dropping off like a rock. So we're seeing 51% to 41%. We've got Goldman revising. We've got Yardeni revising. Everybody is changing their tune since we found out about the China-US, obviously, trade deal to bring it back down to more substantial, more sustainable levels. Although we know that, remember, this market is kind of being held artificially for a few reasons. Tariffs eventually do damage, even if they're being held at 10%. It just takes time, generally at the earliest 3 to 6 months, and obviously usually more on the longer side, even upwards of 1 to 2 years. But the other problem is buybacks. And you might say, why are buybacks an issue? Well, we've got no spending in the future, which is the capex spend. We've already shown that that's dropped off at a cliff and probably will continue to do so. But all the money's been flowing into buybacks, at least for now. And this makes us wonder, are we seeing a similar event to big presidencies that made substantial changes? You can see here Trump's current period in office obviously dropped the market so far like this. But notable ones over here, we had FDR, we had Nixon. These ones actually all recovered to all-time highs predominantly and then dropped later on. Could we be heading for this type of thing? What do you guys think? Like down in the links in the description down below, because of course, this is the argument. What has happened to market structure here? As the markets fell off the way they have, are they showing us signs of really bad stuff, especially after we had those 2 yield uninversions late last year when the Federal Reserve started to pace those rate cuts? Another issue with this is, of course, that we're buying the dip. Yes, retail traders have been the number one purchaser, and in many ways, the street might be wrong here. While retail has been going at a flow that we've never seen once before, 21 weeks of consecutive massive buying, the highest since 2008. At the same time, we've seen institutions actually drop off, more so at around that 5,600 level. So you've got to remember 5,600, 5,660, which we spoke about here on the channel, that was a level for the markets. The reason we know it was because, of course, we saw some large activity, but on top of that, we actually saw smart money start to drop off a little bit. Then the announcement came over the weekend with the US-China deal, and it's possible the street may have missed out on this. So, of course, have we seen the 98 narrative break? Well, we knew that we would probably get an all-time, a new high based on the Fed announcement last week and the trap that we mentioned here on the channel together. But at the same time, we're still ripping higher. And that certainly, along with the breadth thrust, may have killed this narrative, and it may mean that we're in more of the 96 narrative, which is, of course, this pretty strong recovery that's a dull or V-shaped style recovery after we go through this point. Now, this is the other one we've discussed several times on the channel, and it looks like this is currently the most likely scenario. However, we'll talk about a key indicator later on that does show where we probably will end up, and it's not so bad if you are looking to buy the dip still. Percentage of stocks above, as you guys know, if we're led by infotech, we're led by semiconductors, things look really good. And boy, oh boy, are semiconductors flying with this most recent news of course, chip deals being done with Saudi Arabia and others. In terms of dark pool trades, yeah, we got a large trade here. It's only one notable trade. I didn't see too many others. A couple of large stock ones, NVIDIA, Tesla examples, when they're hitting these resistance zones, but nothing to really write home about. And most importantly, no change in trend, okay? So we're just not seeing any change in trend yet when it comes to market action. But one large trade coming through there on IVV, and also notably solar getting a large dark pool here in terms of trade. It's been selling off for a very long time. Has it finally hit its bottom? With earnings coming, we've still got Alibaba, we've still got Walmart, we've still got Cisco, we've got plenty of big earnings. Just remember, if you are trading them and with options, be aware implied volatility is a key. And the reason it's a key is because if it's expected to move plus minus 7.5%, you buy an option, it moves down, let's say 6%, and you had a put and you think you're going to be in the money, you're probably not going to be, because the market has already priced in that. You've actually paid for that implied volatility. When it comes to gold, one of our favorites on the channel, obviously we've been very bullish on gold for a long time. Everybody turned bullish on it in May, which is when we actually stopped being so bullish on it. And the reason was because it had that massive FOMO event. Just remember, we're kind of like in a FOMO event right now in markets as markets rally off this news. Usually speaking, there's an opportunity there. Remember, if Wall Street, which we already know was probably downselling themselves a little bit at 5,600, 5,660, then there's a decent chance that Wall Street will want to get back to that price in the future. And we'll talk about why that is in a moment. But yeah, long China tech, man, that fell off fast. I'm still a believer in long China tech. I think it's going to do quite well. And of course, yeah, you can see there that it's a pretty non-crowded trade in terms of the bull side. Gold to silver ratio, silver still holding better against gold, which we've talked about several times. And in terms of the last 24 hours, we got those inflation numbers and they came in okay. So we had between, I think it was like 0.25 something was the expectation, which was rounded up to 0.3. We ended up getting a 0.2 number rounded down, and we pretty much were realistically on what we expected. Food at home became cheaper. Food away from home was more expensive, and shelter was the sticky one, where we saw, of course, another rise in shelter. And boy, oh boy, shelter has been such a big problem in the US and continues to be so. No one looks at it, no one cares, it seems, but it certainly is. I feel for people that are renting out there. But you guys must be paying some absolutely ballistic numbers. Let me know where you're at and how much it's. Is it ballistic? Is it the worst you've ever seen? Let us know in the comments down below. S&P 500 on a rally. Obviously, a lot of gaps now left behind. And the key here is going to be 59.50 now that we're continuing to rally. We spoke about in our live stream for our private community, links in the description down below. We still have no signs of bearishness since breaking out through that Monday. We did have some, of course, overbought signals here with a couple of positions, but then came the US news. And as we know, the driven market by news, luckily for us, may be partially over. And that means it's more technical now because, as we know, 10% is kind of the baseline tariff. I don't believe those 90-day things are not going to be continuously rolled. Most of you guys seem to agree. But you'll notice here, this level becomes very interesting in the future. The daily 200 sits there. We've got the anchored VWAP, the 20, the 50. I mean, we're going to have like every moving average and so many different fibs sitting on top of these things. So certainly a level to watch in the future. And speaking of which, do we have a sign of any dumping yet? No, the market has come back down to this kind of 58.75 level where you've got a little bit of support from the previous session. If we sell off that, we could go down to 58.50, which is the options low level today updated. But you'll notice the options high level is actually sitting right on the call wall. So let's have a look at the call wall together. And the first thing here with the call wall is the S&P 500 5900 level. Wowzers, look at that. Absolutely massive amount of calls coming through at 5900. And then, of course, 5950 and 6000 become the next big strikes as we move forward through to the OPEX of this month. Now, this is a pretty big deal because this week is massive options expiration.
Walmart is enhancing its optical offerings by doubling AI-powered virtual glasses on its platform. The company is set to report first quarter earnings on May 15th, with analysts noting a decline in EPS expectations. Despite this, Walmart has consistently beaten earnings estimates, with shares performing well year to date. Tesla is set to resume shipping components from China for its Cybercab and semi-trucks following a tariff truce. Additionally, the board is exploring a new pay deal for CEO Elon Musk. The company is also highlighted as a top high-volume stock, reflecting positive market sentiment despite ongoing challenges. Berkshire Hathaway Inc. has achieved a return of 13.47% in 2025, significantly outperforming the SPY's 0.13% gain. The company holds a substantial cash reserve of $348 billion as of the first quarter of 2025.